Hello, everybody, and welcome back. Today, we're going to be talking about good news for jobs. When does that become bad news for the markets? And my name is Michael DeGioia. I'm the Director of Educational Services here at DAS Trader. I'm a licensed professional here at DAS, and I'm joined by Jill Malandrino, Global Markets Reporter from NASDAQ. Jill, how are you?
Good, doing well. Thanks so much for having me.
Yeah, a pleasure as always. So let's. I'm sure you've been talking about this all day today. We're kind of down about 300 points on the Dow, and right now the Nasdaq is down about 100 points. We started the day with what was private sector. The ADP report added 497,000 new jobs, way more than expected, almost by 220,000. The Fed minutes also confirmed that possibly there might be more rate hikes ahead. What is your analysis on this? What are your thoughts on why good news for the economy is bad news for the markets here?
Right. The reaction to me isn't surprising. I mean, the jobs number was expected to come in at 220,000, so you more than doubled what expectations were. In addition, challenger data showed that there were less jobs lost, basically the inverse of what ADP is. And of course, you had JOLTS that came out this afternoon, this morning at 10 o'clock as well. So job market's on fire. Granted, more than half the jobs created were in services sectors, but wage growth hasn't necessarily been keeping up with the amount of jobs that have been added, and that's really key for the consumer. But the fact of the matter is, the jobs data was so strong, blowing away expectations. The market's thinking, okay, we know the Fed has paused. Does this give them the juice to hike another point or two, another session? So that's why you're seeing the pullback in the market a bit. It feels orderly to me. I mean, we've seen it come back throughout the day. I think the market is ready to absorb another two interest rate hikes, but this is a reaction to what we've seen with the jobs number. So it's one thing to note that June is typically the best number in terms of jobs data. More added,
Yes.
less lost. So that's,
Yeah,
you
I
have to
mean
factor
it's
that in there.
summer hiring basically, right? I mean
Yeah,
that's what this is. It's a
yeah.
strong summer hiring season. And I mean this is what we would normally call seasonal hiring. But obviously the market's taking. I mean, the market was down about 500 points at the open on the Dow, and then it slowly and gradually kind of creeped back up most of the day, like you had mentioned. It's kind of pared its losses.
Well, it's
Um,
interesting. I had an investment strategist on the show today from Pennington Partners, and he made a really great point and analogy in terms of interest rates and the economy playing catch up to their strategy. And we just haven't seen that come through yet because of jobs. So we went 500 basis points in 6 months. The velocity, the rate of change was quicker than any other time in history. And there's different types of data, one that's coincidental, one that's lagging. And the data that lags, because it happened in 9 months, it hasn't caught up to the Fed strategy yet. So basically, the analogy he said, it's like if you go to a bar, you do 3, 4, 5 shots, it doesn't catch up to you the next morning when you have a hangover. And that's kind of where we are right now, where we haven't seen the effects of interest rates really play out in the real economy yet. And I think the market is kind of scratching its head. Well, jobs data is as strong as ever. So and we keep talking about interest rate hikes, we keep talking about the cost of capital, we keep talking about potentially recession, but we don't see that in the employment picture.
yeah, certainly not after that jobs number. I mean, it was incredibly bullish for the economy. So discussion. Let's just go into some more detail about the ADP number. So the ADP number is obviously it's not non-farm payroll, which is the big one. But it's usually looked at as like the early indicator for what non-farm payroll is going to be. And that obviously ADP comes out on Thursday, and then non-farm comes out tomorrow, I believe. But we kind of talked about why the market is down already. What are your thoughts about the ADP number? Is it a lagging indicator, or is it kind of a leading indicator? My feeling is that it's always leading non-farm number.
You know what? The ADP data, it's considered more unreliable than other jobs data. And it does, to your point, it does come ahead of Friday's June payrolls report, which I think the market and the Fed probably pays more credence to. Recall the ADP revised the formula and the model with how they calculate the jobs data. I believe it was earlier this year or end of last year. So out of all them, it tends to be the more unreliable one. When what's interesting is for consensus tomorrow for the payroll report, they're anticipating 240,000 jobs were added last month, which is lower than the 339,000 jobs that were added in May.
Got it.
Again, you have to think about the revisions. This, it is a lagging indicator in my mind, because the thing is, I don't know why they don't. And there are platforms that provide this real-time inflation data as an example. They're polling economists. They're not polling actual data, if you will, on a real-time basis. So
Yeah.
it is lagging in that respect. But again, they're expecting 240,000 for tomorrow. If we get another blowout number like we saw with ADP, in my mind, the market's going to probably digest the news like it did for today, because again, it's signaling that the Fed is going to continue to hike.
Yeah. So like again, let's just go through what the ADP number is and versus the name non-farm payroll. So ADP number is people adding people to their payroll via ADP's payment system and or other payment systems that do payroll. So that is like for private sector jobs. It is not it includes seasonal hiring. And I think that's key because we are in June. This is the June number. We're in July now, but this is the number for June. And non-farm payroll does not include, it kind of takes the seasonal hiring out of it. It takes the people that are hired for agricultural reasons, et cetera, out of it. So it tends to be a little bit more accurate. And but again, I think that we're kind of bracing for the non-farm number in the reaction to the ADP number today. And we'll probably just get confirmation tomorrow of whatever the non-farm number comes out. But it's good to always take a look at what, and I'm saying this more for educational purposes for traders and investors, to look at the quality of your source material. Like if the source is the ADP and it tends to be a little bit not as reliable as the non-farm number, just look at this and put it in the overall picture, the overall context. And I think that's a very, very important things for traders and investors to do. Um, Finally, let's jump into the banking sector. I mean, the banking sector seemed to be the sector that took one of the biggest hits today. Why is that? Because of the sensitivity to interest rates?
Yeah, I mean that's exactly what it is. I mean, we saw the yields move, but based, when the data came out, and it's but that's what the banking sector, I mean, it always reacts to what we see with larger economic data, such as that, because they are so interest rate sensitive.
So Treasury yields jumped, okay, and I think they're like, I think I saw the number of like 16-month highs or something like that. The jump, but what does that do? How does that affect banks that the Treasury yields have jumped? Is it how does it work? Why is that such a negative thing for banks?
Um, I'm not a banking analyst, so I just want
Okay.
to put that out there. But I mean, everything that the way they um, banks and other lenders, they have to charge more for mortgages. That's one thing, because it's going higher. It impacts all of their products, whether it's savings, whether it's other lending products within their business. It has a negative effect on commercial bank balance sheets.
That's the key, I think.
To a certain extent, but it depends on the size, the structure, the maturity of total bank balance sheets, and of course, how risk officers are hedging depending on macroeconomic scenarios. And we saw what happened with Silicon Valley banks and some of the other regional banks, um, because based on the duration of what they held on their balance sheets and how high interest rates rose, they weren't hedged properly. Let's put it like that. But they
Yeah.
do. I mean, the move in yield certainly does impact how their balance sheets look.
Well,
Um,
I mean,
I'm sorry.
to my understanding, the problem is that when yields go up, the value of the face value of the
Right.
bonds go down, and if that's what the banks have to put their money into secure, secure assets, and treasuries are considered the most secure asset. So those are what they usually tend to hold. So regional banks who are holding treasury bonds, the yields have jumped up, the face value goes down. So basically, their deposit, what they consider secure capital, just basically shrunk. And what they can lend out is based on how much secure capital they have. So, to me, it makes their balance sheets a whole lot more shaky. The question I have for you is, can you think of any other sector that would have this kind of sensitivity? I'm thinking maybe leasing companies, companies that lease a lot of equipment, they might have some sensitivity, but what other sectors might be affected by this jump in treasury yields?
Well, I mean, it, any sector that's capital intensive, whether it's a seed company, startup company, publicly traded company, no matter what size you are, small caps are especially sensitive to it because, again, the balance sheet and cash that's accessible, if you have to continue to access the capital markets in terms of borrowing and the rates are higher, it's going to be more expensive to fund your business. So while it might have a more direct impact on financial services and banks on their balance sheet, it impacts every kind of company. And that's why I think we saw, in addition to the private market and public market valuation reset that we've experienced in the past 12 to 18 months. Part of that is due not just because of valuations and we're looking at businesses more critically, but again, the cost of capital. Banks are less willing to lend. So you're seeing a lot of activity in the private credit market as businesses are looking to access capital in different ways. But the more expensive it is, the more expensive it is to run a business. And of course, that impacts margins, which is the name of the game.
Absolutely, absolutely. Um, All right. Well, I guess that's it. I mean, I'm just wondering, could there be more bank failures in our future? I mean, obviously we don't have anything on the horizon, but I know I saw something, Pac West Bank, kind of got beat up. Pacific West Bank was getting beat up a while back. Is there any other indications that we might have any further bank failures, or is this something that's a threat to the system in any way? Um,
It doesn't sound like it's systemic like it was during the financial crisis. I mean, we've established that. There's always going to be some sort of failure somewhere. I'm hoping, and we've been covering this a lot too on my show, that with newer technologies such as AI and machine learning, that they are looking at risk management in very different ways where they have more predictive models that can run all different types of scenarios and economies that simply human beings can't do, right? And not only is it just trying to manage different economic scenarios. We had a guest on the show today where their platform integrates how CFOs, CTOs, how the entire C-suite looks at risk and managing their profiles. So across the board, there's organizational visibility. So I think you're going to start to see, in addition to this is another story, but in addition to cybersecurity spend and how the tech stack looks, I think that the risk manager office is really going to change as well.
Yeah, without a doubt. And that was one of the things we saw at Silicon Valley Bank. I mean, they didn't have like a risk manager for like 6 months or
10
eight
months.
months.
They didn't have
How
one
many,
for 10
10
months.
months?
I'm not a regulatory expert, but I would, especially in a bank, you know how sensitive everyone is to banks, that they didn't even have an interim one. I mean, that just, I mean, the whole job of a bank is to manage risk. It's what they do. So
Yeah,
thought
basically.
that was
It's what they
shocking.
should be doing anyway. Yeah, so it's kind of crazy. But well, thank you so much, Jill.
You're
Enjoy
welcome.
the beautiful weather that we're
Thank
having
you.
here in New York and have a wonderful weekend.
All right. Take care. Thanks,
See you
Mike.
next time. Bye bye now. Okay, we're going to go to our Dash Trader to take a look at the charts. And we're going to be doing our market analysis section now. So just hang tight with me for a few minutes. All right, so let's jump to the charts. And the first chart that I want to go through is the S&P. So I'm going to take a look at the S&P SPY, which is the broader index. And what we can see here with our trend lines is that the trend line has gotten steeper and steeper to the upside. I'm going to use a trend line rate just so you can see that the line extends out. So you can see here that the yellow trend line is extending up, and then it gets even more steep as we go higher. That's the blue trend line. And we had a 3-bar island reversal and then a gap down. This was the big gap down for today. And then, of course, we've kind of held at this level. But if we continue to go down below this level, it will start to clear in this clear air below it. You can look here. This is the next horizontal level of support, which would bring us down to 430 on the SPY. This is a little bit more pronounced when you look at the QQQ, which represents the NASDAQ. We have a high, a slightly lower high. I'm going to put on a horizontal line just to show what the all-time high is, which is right here. And you can see that it kind of touches and then reverses from that level, but it closes lower. So the low here is closed here. It closed higher here. And then, of course, we've gone under that bar's low. Now we're much closer to going back negative and underneath the moving averages here on the QQQ. We call this a cursive N or a small N pattern, which is a pretty bearish topping pattern. Bearish in that it means that the current move might be running out of steam or have run out of steam. The long-term trend shows that the markets are continuing to go up, getting steeper and steeper as they go. And then, of course, you could see that that was a pretty much like I wouldn't say it broke yet, but definitely a test of the trend line, potentially indicating that this trend has gotten very mature and might now be coming to an end. The one that's really interesting is the DIA. As we look at the DIA, what you see here is that we've never been in an uptrend. We've gapped down, we've rejected off the lows, and we have a high, a lower high. We're at the top of the range. So the Dow Jones much more bearish and relatively weak than the SPY and the Nasdaq. Nasdaq leading, SPY kind of in the middle, and then obviously Dow, the old industrial index, is the most bearish or relatively weak. Let's take a look at Apple, because so goes Apple, so goes the market. Just clear straight shot up. But we do see the gap down and the gap fade on Apple. I'll put the trend line in here on Apple. We get a little bit higher than the trend line. You get the gist. MSFT, kind of a high and then a lower high. Okay, but we gapped down and faded the gap. Tesla's the one that's interesting because it has an island top. That's a very bearish pattern. It's a 3-bar island top reversal pattern, and Tesla looking pretty bearish. Now, Ford made a 3-week run up. Interestingly enough, so did GBTC, which is the tracking stock for Bitcoin, also a 3-week run up, or 2-week run up in this case. ETHE following the tracking stock, ETHE, tracking stock of Ethereum, which follows the tracking stock of or the ETF that tracks Bitcoin. Last but not least, let's take a look at oil. Obviously, good economic numbers mean, and of course, we've had some, production cuts with Saudi Arabia. So we could see that oil could be on the upside. It looks like kind of a low, a higher low, and then another higher low, which is a very bullish pattern for oil. I don't know if it's going to stay that way, but needless to say, you can see the higher lows or ascending lows on oil. There it is on the weekly chart. So you can see it a little bit more clearly on the weekly. And then finally, last but not least, the old man gold also putting in a higher low after a multi-month pullback. And again, that's just showing some, insecurity brought on by the minutes. The TLT, This is again, this one tracks the treasuries. That was that big jump in treasuries. This is an inverse of the treasuries. So you can see a big jump in the inverse ETF would be a big move down. We can see it there for the last 3 days. So we got a lot going on in the markets these days. Live trading desks at the NASDAQ market site ceremony. That's on July 17th. If you are an avid DAS user, or you just want to learn a little bit more about your system, certainly consider coming and joining us at the market site. We're going to be covering, this is on July 17th, we're going to be covering creating a layout for all these different styles of trading: gap trading, swing trading, options trading. Closing bell ceremony starts at 3:30. It's a great life experience. Come join us on July 17th. We have a few seats left, but this is your last opportunity to get in on that event. Stay up to date with all things DAS. Subscribe to our YouTube, DAS Trader TV, and our newsroom. Follow us on social media: LinkedIn, Twitter, Facebook, and Instagram.